Hello there, what's happening, investorholics and friends? Today we're going to be checking out another ETF Spotlight review. Today we'll be looking at REIT, which is the VanEck Vectors FTSE International Property ETF, and this one is Hedged. So for those beginners, we'll just have a quick touch on what is a REIT. REITs are listed vehicles that own and operate property, mainly collecting rent, and they do not run the businesses inside of those properties. REITs are required, real estate investment trusts are required to pass income through to investors. They do not retain it. REITs are not companies and they do not pay a company tax. Hence, they do not pay or distribute franking credits to investors. The sector is traditionally susceptible to sharp interest rate rises and economic slowdowns or rising competition. So while REITs can be a good source of income, the sector's growth characteristics mean investors need to take a long-term view. So pretty much what I do with all my investments is long-term view. I'm not really talking about anything on this channel that is trading or flipping or whatever the hell you want to call it. That's not really what we're here for. We're here to build long-term wealth. So this ETF might be suitable for investors seeking exposure to a diversified portfolio of international property securities in sectors such as retail, industrial, residential, and offices. And obviously, with this kind of investment, you're going to have regular income stream because the companies inside the ETF, they pretty much pay regular dividends out. So you're going to get everything passed straight through to you, because the ETF is just a big grab bag of all the real estate investment trusts in the index. So yeah, happy days. Let's dive on in and learn some more about the REIT REIT ETF. Hey there, investor. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so that you can navigate the markets wherever you are. My mission here at KrackTheSky is to give you the knowledge and the confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. So don't be afraid to give me a thumbs up and also subscribe. It helps get the message out there. It helps pump the algorithm for YouTube. Just in general, it sort of gives me a bit more motivation as well to keep doing these little reviews for you guys. Thanks. Okay, so the standing boring investment objective here gives investors access to a diversified portfolio of international property securities from developed markets, excluding Australia, with returns hedged to Australian dollars. So pretty much just tracking the index. So let's have a quick look at the index. The index is the FTSE EPRA REIT Developed ex-Australia Rental Index, AUD Hedged. That's a mouthful, isn't it? And that consists of securities that are real estate investment trusts or REITs. The company is listed on the exchanges of the world's major developed economies, excluding Australia, that own real estate investments and derive greater than 70% of their EBITDA from rental income. So the management style, it's full replication of the stocks held, of the companies held in the index or listed in the index. Y factor, so the International Real Estate Investment Trusts, REITs, gives you access to a portfolio of approximately 300 international real estate investment trusts divided by country and sector, to providing exposure to commercial, healthcare, retail, office, industrial and other sectors not available in Australia. So it gives you a bit of diversification outside Australia if retailer income is what you're looking for, REIT income. Efficient access to international property investing with low entry costs. That's why I like ETFs, because you can start investing with a minimum of $500. You don't need big, you don't need 50 or 100 grand to go into one of these other type of investments into a real estate investment trust. Income and growth potential. Yeah, so obviously you got that going for you as well. So international REITs generally pay more, dependable on higher dividends than other countries listed overseas. Obviously this one's hedged back to the Australian dollar. That's a good and a bad thing. So pretty much you won't see any fluctuation in the value of the ETF because of currencies going up or down. So you won't get any benefit when say if it's back, it's bought, if the ETF's bought in US dollars, you're not going to see any depreciation in the ETF price if the American dollar goes up. But anyway, that's neither here nor there, so it just cuts out all that currency fluctuation worries. Okay, let's have a look at some numbers. So net asset value of $18.13, trading just below that at $17.99 when I put this together and recorded it. Market capitalization of $78 million, so this is a small ETF. Management cost 0.43%, not too bad. You're going to get a quarterly distribution January, March, July and October. Dividends pretty good, 4.72%. So property has allowed many fortunes to be made by developers and investors globally. Many of these people have built their empires by investing in real estate beyond the Australian shores. So listed real estate investment trusts enable smaller investors to access property without having to invest huge sums to get involved. You don't want to be buying property directly unless you're that way inclined. Investing for income by building a portfolio that includes different types of asset classes which are globally diversified is a way of reducing investment risk. As we always like to reduce our investment risk. So REITs may be a good investment option to achieve some diversification. So REIT is a relatively small player in the REIT sector at the moment, but steadily growing the funds and assets under management. VanEck, similar type of sort of feeling, I suppose, to Vanguard. They are trying to keep their costs low. They're pretty reasonably good at doing that. So VanEck has a track record of a effective implementation, strong liquidity management, and diversification offered. This, pretty much like all these things, this ETF should be serve long-term investors pretty well. Over long term, these things tend to go okay. Okay, let's have a look at the top 10 there. As mentioned, there's 300 odd companies in this index, and that's why the holding is actually quite low, because it's spread across 300 different companies. A lot of these companies I've never heard of before, so we won't spend too much time going through those. If you want to have a close look at those, if you're researching this ETF, feel free. It's probably not a bad option. Have a look and understand the top 10 at least. Total return, this one is actually negative, so you probably want to keep a bit of an eye on that. Having said that, really this thing's extremely young. You're looking at listed on the 29th of March 2019, so pretty much not, 8-10 months just before the crash, 12 months before the crash effectively. So no wonder it's tracking so far behind. So I think give it a bit of time, it'll regain it and take off again. So VanEck holds all stocks in line with their index weightings. The portfolio is diversified across sectors, but akin to most international property strategies, industrial and retail REITs take the majority of the share. So you've got sort of roughly 30% of the ETF is taken up those type of investments. So the strategy is hedging to the Australian dollar, as I was sort of saying before, amidst the long-term diversification benefits of foreign currency exchange exposure. So when the US dollar or wherever these companies are actually based, when their value of their currency goes up, you're not going to see that reflected in the value of the ETF because it's hedged to the Australian dollar. So VanEck Vector's FTSE International Property ETF REIT is a solid choice for diversified international property exposure. The strategy offers currency hedged, tracking the FTSE EPRA, any REIT developed ex-Australian rental index, pretty low cost. Morningstar give this one a bronze rating, so that's 3 out of 5 stars, but I think for me I kind of wouldn't go near this one yet. Really just sort of see how it performs over the sort of longer term, see what it looks like, say at the end of this year, and sort of see how it's performed, and then maybe go back into it. Hopefully this quick overview was helpful for you guys on your investing journey. Hopefully it's added some value. As always, make sure we're doing our own research. Hopefully it was valuable, and stick around for another video coming out shortly. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.